This is Wallet Brief, where we break down what actually moved the U.S. economy this week, without the noise. If prices, interest rates, jobs, housing, or taxes are quietly changing your money, this is where you stay informed. Let's get into what really happened this week, and what it means for your wallet. Before this week's updates, interest rates were already sitting at levels that felt restrictive for many households and businesses. Over recent months, the Federal Reserve had shifted from aggressive rate hikes to a holding pattern, signaling that policy was tight enough to slow inflation but not yet ready to ease. Borrowers had grown accustomed to higher monthly payments, while savers were benefiting from better returns than they had seen in years. The big question heading into this week was not whether rates would jump, but how long they would stay elevated. Looking back, the trend has been one of stability rather than movement. Rates have remained high, but predictable. Mortgage rates have stayed well above pandemic-era lows. Credit card rates have remained expensive, and business borrowing has slowed. At the same time, yields on savings accounts and short-term investments have stayed attractive. This balance has been reshaping spending and investment decisions across the economy. This week reinforced that steady pattern. There were no sudden policy shifts, and no clear signal of an imminent rate cut. Messaging from policymakers emphasized patience and data dependence. The tone suggested confidence that current rates are doing their job, even if the effects take time to fully show up in the economy. Recent statements highlighted the same theme heard in prior weeks. Inflation progress matters, and decisions will be guided by sustained improvement rather than short-term fluctuations. Officials avoided committing to specific timelines, which markets interpreted as a sign that rates are likely to remain where they are for now. Financial markets reacted calmly, reflecting the sense that this week delivered confirmation rather than surprise. The real trend is a prolonged period of tight financial conditions. Rates are not climbing higher, but they are not easing either. This creates a slow burn effect, where the pressure builds over time rather than hitting all at once. The longer rates stay elevated, the more they influence hiring plans, home buying decisions, and consumer spending habits. This week fits squarely into the broader wait-and-see phase of monetary policy. The focus has shifted away from fighting runaway inflation toward managing the risks of holding rates high for too long. Each week without change reinforces the idea that stability itself is now the policy stance. Overall, this week sent a mixed but steady signal. It showed strength in the Fed's commitment to keeping inflation under control, but also highlighted the ongoing strain that high rates place on borrowers. There is no clear pivot yet, just continued restraint. For households, high rates mean borrowing remains expensive. Mortgages, auto loans, and credit card balances continue to carry heavier interest costs, making big purchases harder to justify. On the flip side, savings accounts and short-term investments still offer relatively strong returns. A widely recognizable visual often used in media, such as well-known public figures appearing in everyday economic settings, serves as a reminder that these rate decisions ripple through the entire economy, touching everyone's finances in practical ways. Next week, watch for any new economic data that could shift expectations, especially inflation or employment updates. Any hint that price pressures are easing more decisively could move the rate outlook. Until then, expect more of the same steady tone unless the data clearly changes the story. That's your wallet brief for this week. These changes don't always make headlines, but they do change how much you pay, save, and earn. We'll be back next week with the updates that matter. Until then, stay informed and protect your wallet.